Now, that being said, I do have two questions that came in via email. I'm going to go over those very quickly using the Power Options tools. Ron sent in a question via email earlier. What is the benefit of having a married put versus a long collar? Two different strategies that are very similar, probably the most conservative option strategies you can use even if you're not disciplined and don't have a trading plan. But I use them personally in two different ways. JB then asked, how can I hedge a November 190 short call on Tesla with earnings coming up on July 24th? This is a little bit more difficult to answer, but we're going to take a look at some potential ideas. I'll say that best. All right, all that being said, let's navigate over to the Power Options suite of tools. I'm going to use these tools, of course, to help us with our illustrations of the questions and the answers. I do have other questions that have already come in, looks like from Ben, and I think another one from James. All right, so here we are at the Power Options main page. What you're looking at is essentially a trial account. For those of you just getting started, I of course encourage you to take advantage of the 4 steps that are listed here. Take advantage of looking through the quick start guide. You can go through the free flash tutorials. As I mentioned, we have a variety of free webinars that are archived for you, as well as some during the week. And any trial member or subscriber can schedule coaching sessions at any time. There's no limit to how many sessions you can have. Coaching session is essentially a 35 to 45-minute phone conversation with myself or Ernie. All right, so you want to make sure you take advantage of those to get more familiar with the tools and, of course, get you started on the right path if you're just starting your trial. Now, a long collar is a combination essentially of buying stock, selling an at or out of the money call, and buying an out of the money put for a net credit. In general, this is like a covered call position, and this does kind of relate to Ben's question, and I might, let's see here. Yeah, I might take Ben's question at the very end of this one before I go into JB's question on the naked call because it's kind of similar. But anyway, here's a standard collar position. Selling the at the money call, buying an out of the money put, typically, just as you would with a covered call, with a cash secured naked put, maybe a credit spread, when we're selling premium, we want to keep it shorter term. Typically want to sell every 30 days or less out in time. And on a standard collar, the call and the put will have the same expiration date. It has a capped gain like a covered call, and it has a limited risk as a married put. The married put position that we advocate, discussed in the blueprint, is a married put position. 2 components, buying a stock and buying a put. But to take advantage of the 3 core principles of any trading strategy, the at-the-money bell curve, taking advantage of the time value decay in your favor and proper position sizing, what we look to do is buy this put far out in time and slightly in the money to control our risks, much better than a stop order, to only 4 or 5%. Right away you see the main difference. To start, the married put does not have a capped upside. The standard collar, just like a covered call, and you might say a cash secured naked put, does. So right away, you can almost see how I use these two differently. For a standard collar, if I see a stock that I like, that I think is slightly bullish to neutral, in a shorter term, 15, 20, 30 days, I want to generate some premium, but I want to protect against market uncertainty, outside geopolitical events, anything coming out about a new trade war. I might use a standard collar. If there are companies that I think are showing strength or are strong in their sector but have been beat down recently by market conditions, and I think in the next 3 to 4 months these stocks have a potential to move up 8, 10, or 12%, I'm entering the married put position in that scenario. Those are the 2 differences. Now, in addition to that, let's just look at a search for the long collar. I'll try to go to the initial value screen here. This was something I put together here for this presentation, but just looking at Tesla. But in general, what I look for is sort of this combination. You see, most of these are about 20 to 40 days out of time. It's our default initial value screen. And you want to get a premium. I did fail to mention that. I want to get a decent premium. In other words, I want the call that I'm selling to have a higher premium than the put that I'm buying, so that I'm lowering the cost basis. Helps me lower the break-even on the standard collar form. That's one advantage that using the standard collar has. It reduces the cost basis just like your covered call. So in this scenario, I might look for a little bit higher premium here, but this is about the average. What I'm looking for usually is about a max return of around 2.8 to maybe 3% if assigned just like a covered call, but keeping the risk to about 4% or so. Okay, now on average, I think the collars that I've traded over the years, probably about 14, 15 years worth of standard collars. I still use them in my account. They're not as profitable as the married puts, but the collars, I think on average, my return is around that 2.5, 2.6% on my winners. My average loser is about 3.8%. With those numbers, I still need to be right about 66% of the time in order to profit long term. And this one's a little bit better combination. It's almost 1-to-1, which is pretty good. So on XL, XIL, and X, might buy the stock at 120, sell the just out of the money 123 call for 375, and we're buying the July 115 put for 275. So I take $1 premium in. If I'm assigned at 123, best case scenario, there we go, we'll make 3.1%. If the stock falls below 115 for unexpected events, well, we'll take the loss of 3.6. And then we have a lowered break-even slightly here as well at 119.30 from the current stock price, that $1 premium we received. Now, to be honest with you, this is a few points out of the money, so it's still bullish, not very bullish, but it's only out to July 26, or 14 days out in time. In this case, I'd probably prefer to go a little closer to at the money for a better premium. Rather than going out to the 123, probably go right at the money with the 121. I get $1 better premium. Yes, I'm giving up 2 points for the assignment, so my return is going to be lower, but my risk is going to be lower as well. So I want to take advantage of that ATM bell curve, selling calls or selling puts that are right at the money. This is still close to 1, but it's about a 2.2, lower than my threshold, to about a 3% risk. But I have a better probability of the stock being above 122. I'd probably look for this to be at 2.5. Maybe I should have used the 122. But you see how you can structure it based on your needs. Now, the collar is a good trade, but what else do we see here? It's got a capped gain on the position. If the stock really runs, you want to stay in the position. What are you going to have to do? You're going to have to pay the money just as you would in a covered call to buy back the call and roll to a higher strike price. We still have a decent return of 2.2%, and we do have a guaranteed exit of 2.9%. Now, how I might structure a married put in this case, following the radioactive trading techniques, which I do, is I'm probably going out at least 150 days, again, to put that time value in my favor. Time value decay is very slow. That standard collar, we know in 14 days, the time value of both that call we sold and the put we bought are going to go to 0. Might have some intrinsic value depending on where the stock goes in that case, okay? But what I want to do here is I'd probably buy the December 125 or 130 put. I'm going to use the 125. It's going to be at the money. It's probably going to give me an 8% risk or so, which might be too high. Oh, 6.7. Perfect. Okay, now, why would I do this? Remember, because I'm buying far out in time, and that first image we saw on the first slide when we started the webinar, the time decay curve, I have a much slower time decay buying 150, 120, 90, 60, 30, and 15. So in the last 15 days, you see this rapid time decay. So by buying this option about 180 days out, the first few months, even if the stock stays the same, I'm likely losing less monetary value than if I bought the July or August put and in the first 20 days the stock didn't move. It's a much slower time decay than the near-term options. Okay. Now, all that being said, the advantage here is that the upside potential is still high. And yes, even though I paid a fair amount and increased my break-even, I can still sell calls against this potentially at a later date to lower this initial at risk. The put is not just insurance, it's a second asset that I can manipulate. But the proof's in the pudding, in a sense. So let's go back to the portfolio, and here's two examples. On June 3rd, I went back historically, and this is for Jonathan's questions coming up later on that 190 call he sold. Tesla right now is at 244.83. If on June 3rd I would have entered a collar for July expiration by buying the stock at 178.97, selling the at-the-money 180 call for 15.45, and buying the July 165 put for 10.70, we have a nice position with a 3.3% expected profit, and right now we're close to that 7 days before expiration. But the stock has moved up 36.8% from the bottom. Okay, and Bill, I explained this. The correct way to do a long-term married put is to buy it slightly in the money. The only thing you're risking is the time frame. Bill's question is, why did you buy a 125 put when the stock was around 120? Following the radioactive trading techniques and the three core principles of any trade. Why am I buying far out in time? To take advantage of the time decay. I want to be selling near term, and any time I buy, Bill, for protection, speculation, I want to be buying further out in time to avoid the rapid time decay. And I'll get back to your question in a little bit, Bill, I promise. I'll show you why it's better to buy the slightly in-the-money put far out in time, especially if my growth is expected over a 2 or 3 month period, because the option that's 6 months out in time is not 6 times the cost. I'm paying less per day for insurance. At the same time, the in-the-money put gives me better protection than the out-of-the-money put. It's still a single-digit risk of only 5-6% as you saw, because all I'm risking is the time premium. And it also allows me to take advantage of the at-the-money bell curve. So if the stock moves up as I expect, I might lose some intrinsic value, but guess what? As that in-the-money put goes to at-the-money, the time value is actually going to increase because the at-the-money option will always have the highest time premium at any time on any expiration, and I can use that to roll the put and move the put to actually lower the risk and the cost basis on that total position. Okay? All right, so here we are, of course, with the standard collar. It had a low risk, and we're coming up to a max return. The stock's at 244. It moved up $65 from when we got into the position. And what would have happened if I kept rolling this 180 call? When it went to 182, I rolled to the 185, then rolled to the 190, then maybe rolled to the 200, then the 210 and 220. I'm adding cost. I'm going to be paying more to close the call than I'm going to get for the new premium at the higher strike, and the increased cost is lowering the percentage return and increasing the risk. And I could manipulate this put as well going through this trade. This is still a successful trade. I would let this be assigned at this point with the stock at 244, take my 3.3% return. It was a risk of 5.3, so that's that range I was telling you about with the standard collar. But I'd let this be assigned. I wouldn't worry about rolling it because it matched my trading plan. On the other side, married put, the stock, I know it's a bad example because I don't expect stocks to usually gain 37%. Tesla was really beat down and recovered more than most people thought in the last 25 days, 35 days. So it's up 36%. Yes, I lost a large amount on the put, but without doing any adjustments here, we're at about a 15% return. And I could probably bulletproof this trade, meaning cancel all of the risk by adjusting the put or perhaps even selling a call against the position. Now, that the stock has moved up. Instead of entering the collar from the beginning, capping the upside from the beginning, now that it's moved, I'm sorry, what's my risk here? 17. So let's say we go out 2 weeks to July, give myself some upside. Okay, nothing there at 17, but I could take out about 65% of the risk by selling that higher strike call now. Yep, down to 2.4%, 20.3% potential return if the stock stays right around 245. Okay? This is a better risk-reward ratio now that I was patient. I could move the put up and have no risk on this trade whatsoever. That's one of the 12 income methods that's discussed in the blueprint on our approach to the married put trading. Okay? In relation to all of this, I'm actually going to go back to our XL and X example. We talked about the standard collar. We talked about a far out married put. That's why I'm buying the 125. For Bill, let's step back for a second. If I want to buy further out in time because the option that's 6 months out in time is not 6 times the cost, it gives me a lower cost per day, even though the premium is higher up front. Let me clear out that drawing because that arrow looks silly just sitting there. All right. Now, if we went out to December, and instead of buying the 125 at 13, let's pay half and buy the 110. Oh, that looks pretty good if we're right, and the stock moves up. I only paid half. But remember, of this $13 I paid, $5 of it is intrinsic value. The risk is only $8.55, equal to what the 115 put is. But on the 115 put, the stock has to drop 5 points before that insurance kicks in. I'm still paying $8.55. At the 110, the stock has to drop 10 points before the insurance kicks in, and I'm paying $6.75, $6.65. So that's why my risk is now double digits. It's up to 13.4%. It's still a married put. But I want to control risk to single digits to avoid the slippery slope that is gambler's ruin. That, you know, when you take a 10% loss, you don't just need a 10% gain to get back to break even. You need an 11.1%. If I take a 13% loss on a trade, I'm going to need closer to an 18% gain on what I have left to get back to break even. But you know, if I take a 5% loss, I only need a 5.3% gain on my next position to get back to break even. That's the control that we have with the collar and with the married put position. Again, there's nothing wrong with the collar. The collar is a good trade. It's a good short-term income trade that's protective. It's probably the second most conservative thing you can do with options trading. The first is the married put. But just buying a put month by month by month that's slightly out of the money and quote-unquote looks cheap. You know, if I bought a July 110 put 2 weeks out, it might only cost me $1.10. Okay, this is what I want to show you. This is one thing I wanted to show you, Bill, as well. So here we are, stocks at 120.30, December 110 put at 665. All of that is time premium. Let's say XL and X does not move for the next 30 days. And on August 12th, it remains at 120.30. Well, we have no gain or loss on the stock, and we'd expect to lose about $100, 101 using the Black-Scholes pricing model, on our December out-of-the-money 165, which carried a 13.4% maximum loss. Now, let me take out the December 110. Let me put that December 125 back in at the high price of 1360 midpoint. Okay? There's my 6.6% risk, 890. Right? I'm not risking the 1300. I'm risking the 890. And this break even, yes, it's at 133, but that's only at expiration. If I hold the position all the way to expiration, make no adjustments, accept no dividends, and the stock is below 125, it's the only time I'm going to realize that maximum loss. If the stock moves up $1 tomorrow, this is going to give me a 50-cent profit. But again, we're going 1 month out comparison. We would have lost $101 on that out-of-the-money 110 put, theoretically. Oh, not 823, I'm sorry, 812, my apologies. The stock stays the same with the in-the-money married put. We lose about 135. Okay, it's a little bit more than I expected. A lot of times when I run these scenarios, it's actually less. The in-the-money put will actually have a lower time value. Now this is closer to at the money, isn't it? I'm only going half a strike up, one strike up to the 125, where for the out of the money example, we went 2 strikes down. So that's okay. That's probably, it's closer to at the money, so that's why we're seeing a 135 loss on the in the money put compared to a 101 loss if the stock doesn't move. Now, why is that relevant? Because let's take the cheap August 16th 35 day out 110 put at 226. What's going to happen if the stock stays at 120.30 to August 12th? We're going to lose 90% of that 234. It's going to have a higher decay than the December put options. That's the advantage of buying further out in time than trying to think it's cheap to buy shorter term. And see, the risk here is still 10.3%. That's higher than what I had with the December 125 put, isn't it? Absolutely it is. Not as high as the December 110, which was at 13, but that's only 3% for another 4 months of insurance. That's a fair trade-off. Buying month by month, out of the money, cheap approach to married put is not the way to go, unless it's part of your trading plan with maybe selling an August 125 call as part of a standard collar position because you're not expecting a lot of growth in the next 30 to 35 days. Okay. While we're here, Ben had posted a question. He has a couple questions here, but he had posted a question earlier when we started the conversation here. Okay, he said, can you discuss the pros and cons of buying shares and selling deep in the money call to collect premium and hedge? Okay. He said, instead of buying the stock, okay, well, let's take this example first. What he's talking about is a deep in the money covered call for protection. The married put and the collars that we talked about, we had a protection guaranteed of 10%. The ones I structured were 6%, and the collar was 5%, right? So even if the stock fell 20%, you cannot lose more than 5%, 6%, 10% in this case on the position. So what if I sold an August 110 call and collected 1260? A deeper in the money call, it's 10 points in the money, so it's a little bit less than 10% in the money. It might not be as deep as he's concerning. Well, here we are. What is our downside protection? Well, it's about 13 points. About 9%. What does that mean? The break-even is 107. The stock can fall 9% before we start losing money on the position. That's good. It's a good hedge. But the max profit's only 2.2. We saw standard collars that were slightly better, and if for whatever reason the market turns, earnings season is coming up, and this thing shoots against us, it drops down 15 to 20%, we would only lose 3% on the collar. We only would probably lose 3 or 4% on the long-term married put. We would not be near maximum risk because that December put still has a lot of time premium. Even though you collected premium and you lowered your cost basis, if you're worried that the market could turn and this could see a 10 or 15% drop, you're still going to be at a 7, 8% loss. It's not bad, but if it goes the other way up 10 or 15%, you don't make much. That's really the comparison in this case. Okay, Ben, is that what are you giving up on the upside for what you feel is a proper insurance? And if your trading plan is just to generate 2% every 14 days, or 1.5% every 14 days, or 3% every month, you don't want to go that deep in the money because the deeper is, if I go another strike down, the max return is going to be 1.8. If I go 2 more strikes down, it's going to be 1% or less. Okay, so once you probably get to 3 or 4 strikes in, you're below the 1% range on most stocks. Okay. Now, of course, I don't want to get off on this too much, but the question is, here's the deal. Yes, in this case, the stock would need to fall about 9% or so before you start losing money in the position. We cap our gain at 2.2%. And then Ben says, let me change that a little. Instead of buying the stock, I buy a deep in the money call at 80 delta. I still sell the deep in the money near-term call at 60. Okay, so you're either doing a bull call debit spread or you're doing a calendar spread using leverage. All right, so if I keep the same expiration and I go deeper in the money, say 90, you just created a bull call debit spread. That's it. You've got a reasonable probability of the stock staying above the strike. You've got a 10-11% return. But remember, yes, you're using leverage now, so you're not buying the stock, but you have a higher, well, you do have a higher break even too. It moved up to 108, but you're risking 100% of this value. And sure, the stock has to drop below 90 in order for that to happen. I understand that. But this is a 10-to-1 risk-reward ratio. Right? You could lose 1,800. Okay, let's call it 9-to-1. You could lose 1,800 to make 193. But yes, you've put the probability on your side. Nothing wrong with this. But it shouldn't be a larger portion of your portfolio because of the wild swings. This is the same thing I tell investors. I use bull put credit spreads. This is the same thing I tell investors about out-of-the-money bull put credit spreads that carry an 80 or 85% probability. Is the fact that they can be very successful in this situation, and you can stage it to have that 75-80% probability that Ben's talking about with a deep in the money call and a deeper in the money call. It's a bull call debit spread. That's all it is. And if you put this out 4 or 5 months, it's just a diagonal calendar spread that's in the money, which I would not do, by the way. I'd keep it as a bull call debit spread. But because of this 9-to-1 risk-reward ratio, spreads of this nature should not represent more than 15 to 20% max of your total portfolio. Because in bad markets, you will see wild swings. And one loss might wipe out 10 previous gains. So that's all this has been. I use out-of-the-money bull puts, which is a parity to the in-the-money bull call debit you're talking about. I see no problem with doing this. But it shouldn't be with a larger portion of your portfolio. Think back to events in the last year ago, February 5th to February 9th of 2018, March 21st to April 5th, October 5th to about October 10th, craziness in November, and then beginning of December, crash down until December 26th. Some of these spreads in an instant, even though you're deep in the money, a lot of these spreads, and I know because I was deep out of the money with my bull puts on February 5th to 9th, 2 of those spreads on the first day of that move downwards got near 70 to 80% loss. Same would have happened on the bull call spreads even though you're deep in the money. That's the nature of spread trading. Okay. Now, while we're still here, Bill comments again. He just wanted to see it as a comparison. We showed what the December, I apologize, the December 125 put would have a loss of 135. The December 165 would have had a loss of 101. The August option, let's say the 120, I believe he's asking, which is at 580. So again, we're just doing a married put here. Buying the August 120 put. This is our comparison. Sorry, folks. This is our comparison. Remember, so we saw here, we would have seen the 90% loss. Oh, I'm sorry. What am I doing? 90% loss on the August 110 put. That full $220 would have been lost in the first 30 days to August 12th, 80 to 90% of what we paid. Here, the put was at 588. If it stays the same for the first 30 days, you're going to lose $399. Why? One of those 3 core principles, I think this is pink. Okay, good. What's known as, now let me do it over here, Bill. I apologize. What's known as the at-the-money bell curve. Okay, this is one of the 3 core principles we follow in radioactive trading. Any chain you look at, Bill, whether it's July 19th, July 26th, August, December, January of 2021, the call and put that are closest to the current stock price have the highest time value. Yes, for puts. This is for puts now. Let's not consider calls. Yes, if I go in the money up to 125 and 130, I'm paying, oh, sorry, folks, I'm paying a higher premium intrinsically, but the time value, the true risk, is lower. And as we saw, if we buy the 115, that looks more like Egyptian, or the 110, we're paying a lower premium here, but the stock has to fall before the insurance policy kicks in. So what does the at-the-money bell curve say? When I'm buying, I want to be buying in the money or out of the money. And when I'm selling, I want to be at the money. $399 loss for the 120, the highest loss we saw because you paid the most time value with the at-the-money strike. And we'd expect to see the same thing with the 120 put even out to December. I don't think it's going to be as high as $399, but still out in December. See, this is cost $10.80. That's out of the money, slightly out of the money. That is all time value. Really, it's about $11, but that's all time premium. This is only $6. Yes, the 125 is $13, but $5 of that is intrinsic, which I'm guaranteed to get back. So the time value here is only roughly $8. 130, 10 points in the money at 16. Time value is only about 630, 640, equal to what we're seeing here at the 110, right? So these two time values are equal. Here's the swell. Low, 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 get higher, peak, low, 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 low. Oh, that's off. Yeah, the peak is linked to here to the 120. So you're always going to see the highest time decay with an at-the-money option. So we follow the three core principle. I'm sorry I didn't add that in. We wanted to purchase the 120. Treat this as a married put. Risk is 8.6%. That's not bad. Still under 10%. Still in our single-digit risk that we want to see. 1 month away. Stock stays at 812. Stock stays at 120 on 812. This has a loss of 133. It's about equal to what we would see, I'm sorry, on the 125 put. Okay, but it's higher than the lower one. And if I use the 130 put as an example, that loss would have only been $1 as well. Compared to $399 with buying the near-term put, which has a higher cost per day and suffers that rapid time decay. You're starting to see how these three sort of work together. Okay? That's what we're kind of looking for in this scenario there. Okay? So that's how they all are affected, and that's why I look in the money further out in time with protection. Okay? All right. So we covered Ben's comments there on the in the money covered call versus the call. We kept that in the discussion with the collar and the married put. Really, what's the advantage over one or the other? Depends on your outlook for the stock and what your risk threshold is. Stock is here, deep in the money covered call. You might have what's known as a 9 or 10% downside protection. Stock can fall 9 or 10% before you start losing money on the position. But your upside gain might only be 1 or 2%. You've got good protection, but if it falls 15 or 20 from an unexpected event, you're at an 11 or 6% loss. Married put in the collar are only at a 4 or 5% loss in that scenario. Okay. Yes, you generated premium up front, but that means you also have an obligation. You cap your gain. Collar, I can be at or slightly out of the money, get almost the same return, if not a little bit better, in my opinion, than the deep in the money covered call, but with only a 50% probability maybe of getting assigned. What do I mean? Stock is trading right here. My standard caller might use a slightly at the money or just out of the money call, buying the put for protection. This might still be a 2.5% gain, around what we saw, the 2.2% deep in the money collar, but it's only a 50% probability. You have probably a 70 or 80% on that deep in the money covered call of making the 2.2% if that was your trading plan. In this case, though, if the stock fell 15 or 20, I'm not losing more than 3 or 4% on the position. Same with the married put, which just has the unlimited upside profit potential. More comparisons, the advantage, of course, and the 12 different income methods I refer to on managing that long-term married put, they're discussed in the blueprint. That's the full work where we discuss our approach that takes advantage of the 3 core principles of any trading, not just married puts, but covered calls, credit spreads. The debit spreads are a good approach in-the-money debit spreads, out-of-the-money credit spreads, bullish side, are good approaches. I've been very successful with those. You'll probably see more about that coming out soon at a new product we're going to have that details my entire research into bullet put credit spreads over the last 3 to 4 years. But I'll tell you more about that when it's available. Aside from that, they're good to use, but remember, the in-the-money bull call debit spread or out-of-the-money bull put, which has the same risk-reward profile as a collar, but we're doing them both below the stock price, will carry 9 to 1, 10 to 1, 8 to 1 risk-reward ratio. The lie of leverage can come back to haunt you in this case because if the stock falls, as we've seen in some of those past events in 2018, you might be at a 60, 70, 80% loss, 7 to 1, 8 to 1. You've just wiped out 7 trades in an instant based on the market movements, even going deep in the money or deep out of the money, depending on if you're doing calls or puts. Okay? All right, let's see here.